welcome back. You're watching Stock Watch, and with me, Zinati Kuma, and joining me to take your stock-related questions tonight are Mark du Toit from Oyster Investments and Wayne McCurrie from FNB Wealth and Investments. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS to 41392 or on X using the hashtag StockWatch. Thank you so much for your time, gents. I know that, Wayne, we will be seeing your picture today. Starting off with you, Mark, it's been actually, considering the kind of election, the UK election overhang, they actually didn't see, and even French election overhang in Europe, we actually didn't see those markets lose their footing today. I don't know if it was maybe due to the kind of thin trading from the US markets being closed. Even the JSE was actually on solid ground today. What did you make of trading today?
Yeah, well, the US was closed, so volume's a bit lower than normal. Our market up 0.5%. Really, we saw a bit of a rebound, a continued rebound in the precious metal space and the resources. Also, the rand strengthening a bit against the dollar. The dollar's been a little bit weaker the last 2 days, and so also financials doing a little bit. So yeah, I mean, I guess like there's not a lot of news at the moment because all the companies that have junior ends are busy compiling their financials and their reports, and then we start getting operational updates within sort of the next 2 weeks or so. So we're in a bit of a quieter period in terms of news here on the JSE.
Well, actually, just looking at, because I mean, we know that the precious metals have been under pressure, but we have seen them turning around, especially Sibanye Stillwater this week. Wayne, there's actually a question on Sibanye Stillwater that goes, please explain Sibanye's share price. Yeah, we have seen, of course, being under pressure, but over the last few trading sessions, it's actually seemed quite good.
Yeah, look, I mean, Sibanye, it's easy to explain what the share price does. It's a commodity company. So you're going to have extreme volatility. It's going to go up like crazy in a commodity upcycle, and it's going to go down like crazy in a commodity down cycle. So, I mean, the share price has gone from, what, 20 Rand to 75 Rand, back to 20 Rand, in the last 5 years. And that's very typical, unfortunately, for a commodity company, maybe even more so Sibanye, because remember, they bought all the assets that no one wanted. They're such marginal assets that they only really make a lot of money in the upcycle, and they certainly do make an absolute fortune, as do all other commodity companies. But it's just purely a commodity share, and unfortunately, we're in a commodity down cycle now. Hopefully, we're at the bottom. Hopefully, these share prices we see going up is actually the turn. You never know, because, I mean, they've done it about 3 times since December. But there's every indication now that we may get 2 interest rate cuts in America. And, that will be obviously good for global growth, good for commodity prices. So hopefully over the next 2 or 3 years, we see a commodity upcycle. And these shares perform, they'll beat everyone else. If there is a commodity upcycle, all of these commodity shares, the platinum shares, the miners, Kumba, etc., they will beat every other share just about in the whole world, quite frankly. But it's only in an upcycle. And then, of course, after that, you get another down cycle. I mean, these shares, you don't hold for the long term. Hopefully, you can get the cycle right.
Mark, is Sibanye one of those where you basically have to take most of the lashes in a down cycle and most of the good parts in an upcycle?
Well, I mean, like Wayne said, it's got assets which are highly geared to commodity prices, and that's why the share price moves like it does, because there's a lot of operational gearing within the business. Sibanye also at the moment was of the 4 listed PGM miners, has the weaker balance sheet, so it's even more leveraged to the commodity prices, and that's why its share price moves up and down, sometimes 10% in the day. Also, I think what's interesting is that a little bit hangs off of whether Trump is elected in the US. I mean, we know that he is more pro-combustion engines, more protectionist, so we could see more sanctions on Russian palladium. So there's those kind of things also bubbling under the surface, which is again, as soon as Trump has any kind of win in the US, then we see PGM prices, have a spike. So a lot of volatility in those prices. Yeah, I mean, I'm not sure that there's real underlying demand yet in the PGM metals yet. So we remain underweight.
It's actually really quite interesting, Mark, that you mentioned the weaker balance sheet from Sibanye-Stillwater, and it's something that you're not the first person to say it. Wayne, how much of a concern is this for Sibanye? And do you maybe think that there could be thoughts that they maybe just went a little bit too far with the acquisitions when the cycle was good?
Yeah, well, look, that's how Neil works. He bet the farm. He borrowed an enormous amount of money to buy all of these assets, the platinum mines, the Rustenburg mines from Anglos and Lonhro, and many, many other assets. And he borrowed like crazy, and he got the cycle right. By hook or by crook, he got the cycle right. Then the borrowings made no difference, and they're paying out huge dividends. But in the down cycle, the extra borrowings do obviously cause more concern than you'd certainly get with Anglo-American Platinum. But remember, this is quite normal actually for a commodity company. Remember in 2015, these companies just about all went bankrupt. So most of the companies, they got such a fright in 2015 is that they pulled back on capital expenditure, et cetera, et cetera. So, we're in a commodity down cycle now with the majority of the mining companies with actually fairly strong balance sheets at the bottom of the cycle. I mean, as I said earlier on, normally at the bottom of the cycle, they're almost bankrupt.
Yeah.
Sibanye is not bankrupt, but they've got a lot more gearing than some of the other players.
All right. Well, gents, let's go into food. Is Bidcorp a good investment case for the long term? Looking at their rand hedged top line and competitive advantage over its peers. Mark, Bidcorp?
Yeah, I mean, Bidcorp is a fantastic company in the food services business segment. Typically, what they do is they look at adding small bolt-on acquisitions around the world to add incremental growth to their business, and they're very good at integrating these small acquisitions into the group. And they've been able to do this over many, many years. So yeah, I mean, it is one of the quality companies listed on the JSE. It's also got nice diversified earnings because it's got businesses in South Africa, Australia, the UK. So it's got that diversification already built in. And yeah, I think it is one of the companies that are quality that you can own for the long term.
Yeah. Wayne, is this one where you can't go wrong?
Just about, yes. I mean, when you think back of all the South African companies, put the mining companies aside for a moment because they've always been global. When you think of all the South African companies who went overseas and came back with their tails between their legs after taking a pounding and losing an absolute fortune, in this endeavor, and there are many, many of them that we all know about, you don't often realize some companies got it right, and Bidcorp actually got it right and were incredibly successful. I think them and SAB are maybe the only two South African companies who went overseas and were successful. So, I mean, this is a great company. It's sitting at about an 18 price earnings ratio, which is not too bad considering the quality of the company. The share price might underperform a little bit over the next short while because, in theory, if we get a commodity upcycle, the rand will strengthen. But this is truly, to be honest, one of the very few blue chips on our market.
Yeah. Well, talking about another good company, is the second part of that question is Bidcorp, or should I go for Shoprite, the golden child? Firstly, between Bidcorp and Shoprite, Mark, should it be an either or can you just have them both?
Yeah, I mean, you certainly can have them both. I mean, great quality companies. I mean, for us, we look at the future earnings prospects of the companies. We work out an intrinsic value for the shares. We rank them, and we buy the ones with the highest returns. So I mean, that's our methodology. But both of these companies, for us, they're almost in a similar bucket in that the returns on our numbers are fairly similar over the next few years. Okay. Both quality companies. I mean, we are looking for kind of more companies that can re-rate, that can almost surprise the market. I mean, we're looking to outperform the market, so we're not massively overweight these two, but great quality companies. And if you're going to buy and hold for the longer term, and you're not looking to trade or to necessarily beat the JSE returns, then I think you can hold these and sleep well at night.
Yeah. ShopRite, the golden child. Wayne, do you see this as not changing?
Look, they cannot maintain the lead that they have over the other retailers forever. I mean, the other retailers, you never know what's going to happen with Pick and Pay. I think that'll take a very long time, though. But the other retailers aren't sleeping on the job. So, you know, this absolutely dominant position that they've got specifically related to their earnings, you know, it can't continue forever. But obviously, it's a quality company. It's about a 25 price earnings ratio, which is not excessive given the quality. But, you know, the returns may be a little bit more subdued relative to the other retailers. Look, I know 60/60 has just shot the lights out, and now they've rolled it out to spaza shops, and they're doing it business to business now. I mean, that's going to impact a lot of other players. But, you know, as I said, the other players aren't sleeping on the job.
I mean, obviously, I know that you have to look at, you know, valuations, Mark. In terms of ShopRite, I mean, yeah, you may not expect maybe too much upside from here, but do you also not view it as, you know, maybe going to the stock because it's going to give you a good return over the long time? I mean, I do know that Wayne has said that it cannot, you know, maintain the lead forever. I don't know. Some people would argue the other way. But what exactly do you look at here? Do you look at the valuation? Do you look at the fact that it will still give you, it will still make you sleep at night for a long time?
So, I mean, I think if you kind of break the return down into three components, one is the price that you're paying for it now. So as Wayne said, it trading on a 25 times earnings, it's probably not going to get more expensive. So you're not going to necessarily get a re-rating of the stock where you buy something on a 10 PE and it goes to a 20 PE. That's not going to happen with ShopRite. But ShopRite does, the other component of the return is you get a nice dividend yield. I mean, it does pay close to 3% dividend yield, so you get that return. Plus you get the return of the growing earnings. And we do think the earnings can continue to grow in the sort of the low double digits, 12% a year. So if you take 12% a year earnings growth, your dividend yield of 3%, that's 15% a year, and maybe no additional from a further re-rating in the stock, so you don't get the extra kicker from that. But I mean, that's a great return in a quality company.
All right. I do want to go into the other questions. There's a question on Capitec. Capitec and ShopRite are kind of usually viewed the same way, that, you know, how much more upside can you get? Quite expensive. Where I want to start off with you, Mark said for ShopRite, you won't really get, he doesn't see it getting a significant re-rating. What about Capitec?
Well, I think Capitec's quite similar. You know, we should have all bought it in the middle of last year when it went down to 1,500.
Yeah.
But, I mean, the dynamics are relatively simple to work out whether you think the share is cheap or expensive. It's growing its earnings at twice what the other banks are growing their earnings at. And there hasn't been any surprises on the downside with Capitec. The problem is the rating is almost 4 times what the other banks are. So, you know, I know it's a great company. I got you on that. But there is a chance of a derating happening. And nothing to do with the company underperforming or earnings being a problem or anything like that. It looks very expensive. And I know the argument is, well, it always looks expensive. But I suppose that's a view that you would take on the company. You know, you can buy First Rand at an 8 PE. You can buy Standard Bank at an 8 PE. Or you can buy Capitec at a 30 price earnings ratio.
Mark, would this also be another one that you're not particularly overweight on?
Yeah, so same story. I mean, a great company, but very expensive at the current price. Or, I mean, maybe a better way to say it is on a relative basis, it's expensive because you can get the other South African banks on cheaper multiples, and you know that they're also trading below their historic valuation ranges. So typically in the past, the market was willing to pay more to own these companies. We think that it can go back because we're going to experience economic growth in South Africa for for almost the first time in a decade, which is going to be a nice feeling for everybody. And we think that the foreigners will like to own big, large listed and liquid banking stocks that can grow earnings and pay nice dividends and benefit from a growing economy again.
All right. Wayne, I do know that you have to leave us very soon, so I want to get to your stock pick for today. You said that it's Sasol.
Yeah, well, why not? Just take a nice punt on Sasol. I mean, I know the share price has gone up a little bit in the last short while, not a lot compared to where it's come from. But if there's global economic growth, chemical prices will go up. Sasol's very geared to chemical prices. The oil price will go up, but the rand will also strengthen, if I'm right, in the commodity cycle. So they won't be, benefit too much from oil. But can things get any worse for Sasol? And certainly, when you look at the share price, I mean, this thing's trading at incredibly low valuations. This is of the lowest I've ever seen a Sasol, if not the lowest rating by the market. So
all right. Well, Wayne, thank you so much for joining us. We really appreciate it. I do know that you wanted to come back after your commitment, but thank you for your insights. I think by the time you come back, the show will be off. Thank you so much. Mark, it's just me and you. Obviously, Wayne has chosen Sasol as his stock pick. Would you be as brave?
So, look, I think that the time to buy Sasol is when you think the chemical prices will go up. So Wayne is quite bullish on increasing global growth with interest rates coming down, and he's expecting chemical prices to go up. I'm a little bit more skeptical. I think that there's still quite a bit of capacity in the chemical space. Sasol needs to demonstrate that it can earn dollars from its cracker in the US. I think that, he's right, it's very cheap. It's trading on a much lower multiple than it has in the past, but they've got a lot of dollars debt to pay down, and they need to make dollar earnings out of that chemical cracker in the US. So when I start to see the chemical prices go up, then I'm going to be very excited, but I haven't seen that yet.
All right. Well, Mark, let's go into the other questions. There was a question on Richemont and the kind of returns that we have seen there. Richemont, is it also another one that always looks expensive?
Yes, it does. I mean, it's in the luxury market, and typically companies that sell luxury goods, they sell them at very high margins. People buy the products because they're not worried about what it costs. In fact, they buy them because they're expensive, and they want to show people that they have expensive things. So these companies earn fantastic returns, and that's why they trade on high multiples. So it always does look expensive, but a fantastic company. I mean, it's done incredibly well over the years, globalized business. So gosh, I mean, you would love to own it. There are times when it underperforms.
Yeah.
But over the long term, a fantastic business. And there's this idea that LVMH might want to maybe buy them out at some point, which would be an incredibly large deal if it does happen. But there's also that kind of hidden upsides. If there's any kind of underperformance in the stock, I mean, they might come and try and take it out.
Well, as we're talking about Richemont, also Reinet. What do you make of Reinet?
Yeah, so Reinet's a little bit more complicated. So their big holding was BTI, British American Tobacco, and over time the idea was that they would sell that stake down and reinvest in other businesses. They made a great acquisition in Pension Corp, which is a business that buys up retirement liabilities from other companies, and then it does some cash flow matching, and so it takes the commitment off the balance sheets of companies mainly in Europe. They've done very well. It's just the problem for us with Reinet is it's difficult to value that Pension Corp business, and it's almost, you can't really get an insight into how they are cash flow matching and what instruments they're using. And so for us, it's a little bit more more difficult to value. But I mean, it's done very well.
Yeah.
Just difficult to know what's in there.
But I mean, in terms of the, British American tobacco, would it be a good enough reason that they have this big exposure to British American tobacco to go into the stock?
I think if you like BTI, you should buy BTI
Straight.
outright.
Yeah.
Yeah, I mean, you can, and then you don't have to worry about the pension core business. Reinet does typically trade at a discount to its assets as well. So I would just buy BTI if you like that space. BTI has its own specific issues, though. I mean, they've been under pressure in the US. They're being they've been outsold by cheaper vaping products that are coming in illegally into the US, and for whatever reason, the US has been slow to stop that happening.
Yeah.
Also facing a few legal battles. I mean, they've got a big lawsuit in Canada, so they're not without their issues. But it's always been a company that's able to grow its revenue, and also a globally diversified business and a very large business and great dividend payer.
Yeah, seeming like a lot. We've been dealing with illegal cigarettes. Now it's illegal vapes. It's a lot. What about Afrimat? Would you be going in this for the long term?
Yeah, Afrimat's been a fantastically run business. Got a really highly rated management team. They do very innovative deals. I mean, they always talk about how they look at the logistics aspects to a deal. They started out by buying up quarries, did very well out of that. So the business is in three parts. Got the construction materials business, industrial materials, and then they've got their mid-tier mining companies. So they've got a decent sized iron ore mine. They've recently gone into anthracite mining at Nkomati. And the latest deal was the acquisition in the cement space. And
Lafarge.
Lafarge, yes, they paid a very low price for a company where the offshore owners wanted to exit, paid a great price, and they have some fantastic assets. And now we just wait to see what fantastic things they're going to do with these assets. So yes, I mean, I think you can hear from my spiel is that we like Afrimat. We think that the management team will continue to do well and really good at generating cash returns and then reinvesting it in new and innovative ways.
Before we get to your stock pick, there's a question here. What have you made of Grindrod's growth over the last 5 years?
Grindrod in the logistical space, everyone's getting excited about public-private partnerships, and perhaps Grindrod being making a bid for some of Transnet's assets and turning them around. They've also got fantastic port assets already that they own. So I would say that's the Grindrod story. I mean, I think a lot of it is already baked into the price, but if they're able to do a fantastic deal, get an asset, turn it around, then there's further upside. But at this point, we'd like to see a deal kind of materialize before we get more excited about Grindrod.
Yeah, and really a lot of excitement that is in that stock. It has run quite a lot over the last year at least. Mark, let's get to your stock picker for today. What are you choosing?
Yes, so like I said, I still think that South African banks is a good way to play the economic recovery in South Africa. So I'm picking Standard Bank tonight. It had a fantastic year last year. I really shot the lights out. Earnings grew by 27%. The Standard Bank Africa business had a really good year, plus had the weaker rand, so they had that additional benefit. This year, the earnings growth are going to look more subdued, rand strength, but 65% of their business is still South Africa, and they will benefit a lot if this economy can go from a 0.5% real GDP growth rate to a 2%, or even if we can dream a bit even higher than that.
Yeah.
So they have this fantastic base in South Africa. They've got the scale, and in banking, scale matters a lot. You've got a big fixed cost base, and if you can, if the lending environment allows you to lend faster, and because the economy is growing, the bad debt ratio comes down, these businesses are very leveraged to a growing economy. And I think that the share price is only up 2% excluding dividends so far this year, so it hasn't really gotten going yet. And I think you'll get a nice dividend yield plus earnings growth and even a bit of a re-rating because you're not paying an expensive price for the stock.
All right. Thank you so much for your time and for your analysis today, Mark. Really, really appreciate it. And to Wayne, of course, earlier on. That is all for tonight's Stock Watcher. Thanks to our guests, Wayne McCurrie from FNB Wealth and Investments and Mark du Toit from Oyster Investments. Up next, The Close. Stay tuned.